If you sell something for a few $1,000,000, why would you want to pay all those taxes up front? You don't want to be a part of that higher tax bracket that first year when you could defer them. So what you're saying is going to resonate kind of with the people we're talking about. And I think it's a good value add to either partner with someone like yourself or even just kind of position someone like yourself for the people we're working with.
Talk about some of the themes that you're seeing with some of your clients when they show up, without giving any particulars, but just talk about like, hey, someone shows up and this is the challenge they have, and then let's walk through how we can help them using the deferred sales trust.
Yeah, so we come across clients all the time that have highly appreciated assets, like you said, with capital gains on them. And there's not many options of mitigating some of those taxes when you're like deferring them over some of the years. Like we could look at a CRT, you could look at a deferred sales trust, and a few other things like 1031 exchanges. But there's some limitations on some of those too. So you were telling me about the DSTs. Um, Honestly, for myself, I don't know too much about them, just based on what we've talked about. I'd love to learn kind of more about how you structure them. I know you're putting out videos all the time on how you arrange these trusts for clients and how they're benefiting them for them in the future, and you're deferring these taxes down the road, which is really what these clients want. I mean, if you sell something for a few $1,000,000, why would you want to pay all those taxes up front? You don't want to be a part of that higher tax bracket that first year when you could defer them. So what you're saying is going to resonate kind of with the people we're talking about. And I think it's a good value add to either partner with someone like yourself or even just kind of position someone like yourself for the people we're working with. So I'm excited to kind of hear more.
Yeah, let's geek out a little bit with this. And I can agree with you more, right? I mean, taxes are massive, right? And it's somewhere between 25 and 50% of every sale going to be wiped out by capital gains tax and depreciation recapture, right? And especially real estate. So you've owned it like, for over 27 and a half years for multifamily, you fully depreciated at that point if you've been taking straight line depreciation. If you own commercial property, it's about a 39-year schedule. But if you do these 1031 exchanges, the old depreciation schedule travels, and we call, not having a big depreciation schedule. That's not great because that creates more tax. And so we look at something called tax flow versus just cash flow, right? And trying to mirror them up with every dollar you're taking in cash flow. Ideally, you have tax flow to offset that. And that's the kind of the back to kind of the Rubik's Cube scenario. How do you maximize your wealth by being very tax efficient, but especially as it pertains to large assets that are being sold? So for example, if you bought a property for $1 million, 20 years ago, and it's worth $10 million today, it's a $9 million gain on that gain. Let's just say you're in New York or California, you're looking at approximately 40% of that, probably minimum being taxed, right? So that's a huge tax liability that at the close of escrow is going to be paid. Now you can do a 1031 exchange like he's talked about, but oftentimes 1031 exchanges for a lot of our clients, they don't want to be forced into a tight time frame, which is not great for making decisions. Two, they don't want to take on a lot of debt right now, with debt not being as favorable as it used to be. Three, they might just be looking to retire and diversify. They're moving more into a preservation mode, which leads into maybe the CRT. And the CRTs absolutely can be used, but they're typically for someone who wants to give it all the way to charity, 100%. And so that becomes, for some clients, that's what they want to do. But most of our clients maybe want to give 10, 20, 30, 40, 50%. They may not want to give all of it to charity. And so that's where we found CRTs aren't as popular as they once were, once people learned about the deferred sales trust, which gives total flexibility to either not do a 1031 exchange, but also to not have to do a CRT, but also to be able to diversify within multiple assets. And that's the beauty of the deferred sales trust. It can be back to that customized plan. It can really start to be able to move. And my daughter, if she were here, she could actually, she's the one who put it all to green. I can't actually quite do that yet. I'm trying to figure that out. She's 11 years old. She can figure this thing out. But, move this thing around in such a way that it starts to align with individual goals. And a lot of those goals are debt freedom, diversification, liquidity, and the ability to invest into multiple assets at any time. And so that's why we love the deferred sales trust. If people want to learn more about that, you go to capitalgainstaxsolutions.com.